Basically, it's what the industry, largely had feared. The specifics are still, to be finalized, but the general idea is that bank capital requirements are going to rise here fairly significantly. For the largest banks, it looks like they could be required to hold as much as 2 full points of additional capital. That might not sound like a lot, but that is a lot. And then potentially, more, maybe not quite so much more for, mid-sized banks, but they are also proposing a rollback of the thresholds for stress testing and incremental buffers to those banks at 100 billion in assets and larger. Recall that a few years back, that threshold had been raised from 100 billion up to 250 billion. Some people pointed fingers at some of the regional banks that ran into problems, pointed fingers at that sort of relaxing of the rules. As far as implications, obviously, for the banks themselves, this is going to hurt. It's going to reduce their returns on capital, obviously, because they'll be holding more capital. It's going to force them to think carefully about risk weightings. In other words, different activities carry different risk weights. And so they'll have to think carefully about engaging in activities that carry higher risk weightings. So that's likely to push them further up market in terms of their exposure categories. It's also, in the interim, going to negatively affect capital returns. So in the form of share buybacks and incremental increases in dividends, those likely across many banks are going to be suppressed here while they sort of wait for these finalized details to be ironed out. To be fair, a lot of the banks are actually now pretty well overcapitalized. And so, the impact may not be quite as significant as it sounds, but banks don't like to run capital levels right at that sort of, minimum threshold. They like to have a buffer. So it is still going to reduce overall lending activity. And as we've talked about a lot, there is a credit contraction going on. We've been seeing that for several months now, and it continues to accelerate to the downside. I talked about this just yesterday, looking at the latest H8 data. So these stricter capital requirements, more stringent stress testing, is only going to add to that, and so that's going to continue to create a more challenging macro backdrop as we move forward here, not just over the next couple of months, but over the next couple of years.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.